Hello, welcome to the Centennial Advisors Market Update for March 2025. My name is Jeremy. I am a financial advisor here at Centennial. So in today's discussion, we are going to talk through a few macroeconomic factors and their impacts on the stock market. So first of all, we're going to start with speaking about GDP. Gross domestic product was up 3.0% in the fourth quarter of 2024, which basically was right in line with economist expectations. The change is starting to happen in Q1 of this year. The Atlanta Federal Reserve keeps track of real-time data. It's this real-time data that is starting to show a few cracks in the foundation. It is entirely possible that we might see a slight decline going forward in GDP for the first quarter. So the second big issue that we've been seeing over the past several years, of course, is inflation. That's been a really big deal. It's been biting into people's pocketbooks over the past few years, and that has not slowed down. The Consumer Price Index is the broad measure by which the government keeps track of inflation data. In January and February of this year, 2025, the Consumer Price Index has come in at 3%, right on the dot. So that is actually a little bit higher than what analysts and economists were expecting. On the other side, though, the Federal Reserve's preferred inflation index is the Personal Consumption Expenditures Index, or PCE. That one came in a little bit more in line with expectations. Now, obviously, nobody likes inflation, and this is certainly impacting sentiment right now. It's impacted sentiment for the past couple of years, and that is continuing. So consumer confidence surveys, these are important to look at to see what the consumers are doing, and then that translates into what the consumers will eventually be spending. Consumer confidence surveys declined by 10% in January and February. This is actually the fastest decline that has happened in the last 3.5 years. So inflation expectations moved up very dramatically in February. Normally speaking, these are very small month-to-month changes, but the outlook for inflation expectations increased to over 4%, which has not happened since 2022. So that is likely driving a lot of the negative consumer sentiment going forward. And when there's negative consumer sentiment, that does bode ill for future spending trends in the economy going forward. Also, these consumer sentiment surveys are showing that the discussions around tariffs are having a meaningful impact on consumer sentiment. And if consumer sentiment declines, there is the risk that consumer spending does slow down throughout the rest of this year. So with all of that being said about the GDP, the inflation numbers, and consumer sentiment, we are still seeing a fairly healthy industrial production and retail sales numbers so far this year. This does remain modestly positive, so it does bear watching though. Now, all of this could certainly change throughout the year if the proposed policies out of Washington, D.C., such as the tariffs that I mentioned earlier, are implemented as they've been discussed. It could have a meaningful impact. Now, switching gears to the Federal Reserve, the Fed, given all of this information that we've talked about so far, is starting to take a little bit more of a conservative stance with regard to their rate-cutting policies going forward. The inflation numbers are really what they're focused on at this stage of the game. The Federal Reserve's meeting minutes from January came out, and what we noticed within that is that the Fed is seeing some upside surprise potential to the inflation numbers going forward this year. So they're a little bit more data-driven, and they want to be able to see a little bit more progress towards their 2% inflation target before they start cutting interest rates further. Now, obviously, the housing market continues to be very, very sluggish. This is a combination of high interest rates and limited supply on the market right now. With obviously 30-year fixed rate mortgages hovering around 7%, that puts a real damper on home sales. And it does not appear that that interest rate is likely to shift too much going forward. The other issue that is potentially going to be something to watch, at least for the housing market this coming year, is going to be the implementation of 25% tariffs that the administration has announced on Canada. Now, the U.S. imports a significant amount of lumber for housing from Canada. Now, if we do get those 25% tariffs, which that is always a big if, it could increase the cost of new housing and new home builds. Now, finally, we're going to finish up by talking about the current state of the stock market. After 2 years of very, very healthy returns in 2023 and 2024, we've entered a market in 2025 that is still searching for direction. The markets so far this year have been a little bit up, a little bit down, but as of the close on March 3rd, the S&P 500 is actually down slightly year to date. Now, thinking through the outlook for 2025, what are we looking for? In my mind, there could be significant tailwinds to the market, as well as significant headwinds to the market. The potential for tax cuts and deregulation obviously could be a net positive for the market going forward. On the flip side, though, I see potential headwinds coming from ongoing deficit concerns, a tightening labor market, and trade tensions. All three of those things could be significant headwinds going forward. Now, of course, all of this is going to depend on the impact to corporate earnings throughout the year. So it is with volatile markets like these in mind that we construct client portfolios using the portfolio pyramid approach, using protected as the foundational layer, combined with growth in income and long-term growth to fit each person's specific situation. So if you would like to discuss any of this that I've covered today in more detail or discuss your portfolio in more detail, please, of course, don't hesitate to reach out to us here at Centennial, either via email or call the office line directly. Thank you.